Welcome to this explainer. Today, we're diving straight into the structural mechanics of business formation. We're going to break down the exact cause and effect relationship that builds a functional financial firewall around your personal assets. We're looking way past the standard paperwork here to see what actually shields your wealth. So, let me ask you a question. Is your personal wealth legally shielded from your business right now? Let's challenge a really dangerous yet super common assumption. The idea that just registering a business name or forming an LLC automatically equals a functional legal barrier. A lot of people just assume that piece of paper means their personal wealth is instantly walled off. But functionally, is it really? Well, the harsh reality is that in a lot of cases, it absolutely isn't. If you entangle your personal and business finances, you instantly neutralize the exact legal protections you probably thought you had on lock. The mechanism of failure here is the loss of independent entity status. It literally doesn't matter how ironclad your formation documents look. If your funds are commingled, those funds are telling a completely different story, both legally and functionally. To really deconstruct how this works, we're going to walk through 6 key areas. 1. The illusion of legal protection. 2. Acquiring the federal identifier. 3. Establishing the operational vessel. 4. The mechanics of commingling. 5. Unlocking institutional credit. And finally, 6. Strategic financial implementation. Okay, let's jump right into section 1, the illusion of legal protection. Filing formation documents, things like your articles of organization, definitely creates a legal entity on paper. But expert analysis clearly stresses that it offers exactly 0 functional protection if your financial operations stay entangled. You kind of have to think of formation documents as just the blueprint, not the actual building. They're basically a paper shield. Unless they're backed by strict, highly verifiable financial boundaries, that shield is going to shatter under any real legal or regulatory scrutiny. Moving on to section 2, acquiring the federal identifier. This brings us straight to the employer identification number, or the EIN. Expert consensus defines the EIN as much more than just a random administrative checkbox. It's a distinct 9-digit federal code that basically acts as a legal entity's financial DNA. It gives you systemic recognition. Without it, you literally cannot legally track tax obligations, you can't hire employees, and most importantly, you cannot secure banking infrastructure. It's the absolute mandatory core identity of your entire business structure. All right, section 3, establishing the operational vessel. To actually construct that physical boundary separating your personal and business liabilities, financial institutions are going to require exact, completely non-negotiable documentation. Generally speaking, you're going to need your articles of organization, your EIN confirmation letter, and an operating agreement. Why those 3? Well, institutions demand them together because they form a kind of overlapping verification system. They validate your existence at the state level, the federal level, and your own internal governance level. Handing these over is what establishes a recognized, genuinely independent financial vessel. Now, this newly established vessel has to be the sole legal routing point for absolutely all of your business transactions. Every single dollar of revenue has to flow into this account, and every single business expense must exit from it. No exceptions, none. This strict routing is a non-negotiable compliance standard. It really serves as the foundational mechanism of your whole liability shield. Which leads us to section 4, the mechanics of commingling. So what actually happens when that operational discipline fails? Well, the entire structure collapses. On one hand, separated operations keep your liability shield perfectly intact. The business is acting autonomously. But on the other hand, commingled operations completely destroy it. When you use a personal account to pay for business software, or vice versa, you are legally piercing the corporate veil. Analytically speaking, if you're treating the business like it's just your personal wallet, courts and regulators are going to view you as what they call an alter ego of the entity. and that completely erases any legal distinction between you and the business. The consequence of doing this is incredibly harsh. Commingling exposes your personal home, your vehicles, and your life savings to business liabilities. Let me be clear. If your financial firewall is breached because of sloppy operational mechanics, a single business lawsuit or one unpaid corporate debt can legally wipe out years of your hard-earned personal wealth. That paper shield of your LLC, it is not going to save you. Section 5. Unlocking institutional credit. When experts analyze institutional lending, a really clear pattern emerges. Banks do not lend to ideas, they lend to structured, verifiable cash flow. If they're going to extend credit, they absolutely require an EIN-linked account, a perfectly segregated transaction history, and hard proof of consistent business revenue flowing through that specific vessel. Without an active, demarcated operational vessel, doing things like securing capital, expanding operations, or acquiring disaster loans, it becomes structurally impossible. You just can't prove the business makes money completely independent of you. Finally, Section 6, Strategic Financial Implementation. So how do you extract wealth safely from all this? You do it through the actionable mechanics of the owner's draw. This is the only legally compliant way to pull out capital. Step 1, all revenue enters the business vessel. Step 2, all business expenses exit that same business vessel. Step 3, when it's time to pay yourself, you execute an owner's draw. That's a strictly formalized transfer from the business vessel directly over to your personal vessel. You're totally in control of the amount and frequency, but it has to strictly follow this linear, very deliberate path. And to defend this mechanism, documentation is literally everything. You have to record the date, the exact amount, and explicitly classify the transaction as an owner's draw. Expert consensus shows over and over that bookkeeping isn't just some boring administrative chore, it's the defensive armor protecting your liability shield. Proper documentation proves your intent. It proves to any regulator looking that the transfer was a legitimate intended distribution of profits, not just a commingled mistake. I really want to cement this mechanistic relationship with a crucial insight derived from expert analysis in this space. Quote, "A tax identifier without a dedicated operational vessel is merely a dormant number. It provides neither legal protection nor financial leverage," unquote. You see, getting the EIN is really only half the battle. Activating it through a strictly demarcated bank account is what actually brings your whole business structure to life. We've deconstructed how even the slightest entanglement can bring down an entire corporate structure. So take a step back and evaluate your own operations. Have you built a true structural financial firewall? Or are you operating behind a mere paper shield? Thanks for joining me on this explainer. See you next time.